Oi!
My name is Brent Johnson. I am the CEO of Santiago Capital in San Francisco.
The Dollar Milkshake Revisited.
So the dollar milkshake theory is something I coined about 18 months ago. And essentially what it is I believe that the central banks over the last 10 years have created this milkshake of all these different currencies. They've pushed liquidity into the global economy, yen, euros, dollars, pounds. And for a long time, it was just kind of circulating out there. But, as of, I think, 2016, we kind of got into this divergent monetary policy where the U.S. started raising rates while the rest of the world was still mixing the milkshake. And raising the rates and having rates higher on a relative basis to the rest of the world acts as a straw which sucks capital into the United States. And I think that has happened, and I think that will continue to happen. And I think that means positive, while it's not going to be smooth and there's going to be times of great chaos along the way, I think it's positive for U.S. asset prices. Yeah, so I think when I first came on and started talking about it on Real Vision was around May or June of 2018. And since then, what we had a couple more rate hikes, and subsequently now, just in the last 30 to 60 days now, we've had one rate cut with another expected one in the United States. And I think what's really, really interesting about it is everybody in the various camps can, to a little extent, still say they're still in the game and their point of view is playing out. I had been calling for equity prices to go higher, and they went higher in 2018, and they had a huge sell-off at the end of 2018. I got very aggressive at the end of December and bought call options because I believed the equity prices were going higher because of this theory. And we had a great run, kind of back to the all-time highs now, or near the all-time highs as of middle of September. But that doesn't mean that they're going to bust out right now. We might have another pullback. Would not surprise me at all if we have another pullback before the end of the year. But ultimately, I think, equity prices are going to go higher. The other thing that's happened is, bonds sold off pretty aggressively in 2018, and the yields on the 10-year went above 3% in the fall. But we've seen that have a huge move back the other way. Rates have fallen. The 10-year bonds around the world have rallied like crazy. We've got, the U.S. 10-year is down back to, I think it got to 1.5, and now it's, I think, around 1.7. So we had a huge rush back into treasuries, not just U.S. treasuries, but treasuries around the world. We went from $8 trillion of negative yielding bonds a year ago to $16 trillion of negative yielding bonds now, which is just unheard of. It's crazy. But then in the last couple of weeks, so that was done on the fact that even the Fed started to get dovish, and they were thinking that monetary policy would be a factor, and it still will be. But you've seen just in the last 10 days. People are starting to push back on the negative rates trade, and even some monetary authorities saying we're not sure that those negative rates are healthy or going to work. So, in the last 10 days, you've seen a big sell-off in sovereign bond yields, and I think the negative yielding debt has gone from 16 trillion back to 14 trillion or something like that. So they're kind of crazy numbers, and it's kind of a crazy time period. But I think, the dollar bulls a year ago, me included, said, we're going to see a breakout in the dollar, and it's broken out a little bit. But we haven't had the runaway breakout yet. The dollar bears have said it was going to crash, and it hasn't really crashed yet, but it hasn't really broken out yet either. So they still think that they're in the right. And, it's anybody's game as to which way this is going to go. Now, I obviously have a strong opinion, and I have a strong belief in which way this is ultimately going to go. But we're kind of in that period where everybody can, still say they're in the game. And it's going to be interesting how it all works out.
What's happening with the broader dollar?
Yeah, so one of the things I think that's kind of interesting is a lot of times when people focus on the dollar, they look at the DXY. And I talk about the DXY a lot too. And the reason I talk about the DXY is it's heavily weighted to the yen and the euro, and those are the two biggest competitors to the dollar. The yuan, to a certain extent, people think of as a competitor, but as far as the DXY, it's a minor component. And the fact is that the euro has weakened a little bit versus the dollar this year, and the yen has strengthened a little bit versus the dollar this year. So while the DXY index is up a little bit, 3, 4, 5%, the broader view of the dollar is that it has broken out. If you look at the Asian dollar index, it broke through support of like a 20-year support line. And if you look at the dollar versus a number or a basket of Asian currencies, the dollar has clearly broken out. If you look at the dollar versus the G10 currencies, other than the yen and I think the Canadian dollar, all the G10 currencies are down, in some cases dramatically, versus the dollar. If you look at the broad trade-weighted dollar index, it broke through the long-term resistance, and it is now clearly broken out. So if you just focus on the majors, which is the euro, the yen, and the dollar, not much is really going on. But if you step back and you take a bigger view of the dollar versus a number of world currencies, the dollar is clearly wreaking havoc. You've seen this in places like Argentina. I mean, their currency is now down 60% versus the dollar in the last couple of years. Their stock markets are in the same range. Same thing has happened to Turkey. Same thing has happened in Venezuela. I've talked before about the Highlander example between, the dollar and gold, or kind of like Connor McLeod and the Kurgan from the Highlander movies. And at the end, there can be only one. And, I think gold will ultimately win that battle. But I think that battle's a few years down the road. I think in the meantime, the dollar's going to go around the world cutting off these other currencies' heads. And I think that's what we're starting to see. And I think you're going to see more of it going forward.
What's your view on de-dollarization risk?
So one of the big key issues to my overall thesis is the demand for the dollar. Now, a lot of people will say that the world is de-dollarizing. People don't want to use the dollar anymore. They don't like that the U.S. has been acting from a bully pulpit and directing the world order. And so that they're going to de-dollarize, they're going to leave the dollar, and that's going to decrease demand. But the real world, the reality is that over the last 10 years, emerging markets and international entities outside the United States have issued $12 trillion to $13 trillion of negative yield, of dollar-denominated debt. So the demand for dollars, for that debt that they have issued, if they had the same interest rate as the average outstanding U.S. Treasury, which is 2.3%, then that would mean that these entities owe, on an annual basis, just to service the debt, need $300 to $400 billion of dollars just to pay the service fee on the debt that they've issued. And the bigger issue is that they've taken out this debt over the last 10 years. In 2007 or 8, it was around $4 or $5 trillion, $6 trillion. Now it's $12 trillion, $13 trillion. But we're 10 years down, and so a lot of these loans are coming due. If you look at the payment schedule for maturities of a lot of these dollar-issued debt by these emerging markets, the maturities are 2019, 2020, 21, and 22. So the next 3 or 4 years, they not only need the dollars to service the debt, they need the principal payment to pay it back off. And so I will often hear, well, they'll just default. They're tired of the dollar, they're just going to default on the debt. And that sounds like a great theory, and if they did that, that would decrease demand for the dollar. But the issue is that because all money is loaned into existence, if you default on debt, the supply of money crashes even further and faster than the supply, or the supply of money crashes even further and faster than the demand crashes. And so if people start defaulting, not only will the price of the dollar rise because supply is just collapsing, but those countries who have now defaulted, they're going to have even more trouble raising external capital because nobody will want to loan them money again if they've just defaulted on a recent loan. And if they start raising money in a non-US dollar, then do you think the US is just going to say, okay, no problem? No, I think the US will then say, well, we're not transacting with you not in dollars. And so now all of a sudden, or they'll put new tariffs on them, or they'll say, we're not going to do business with you because you just defaulted on our banks. And now they're locked out of the biggest consumer market in the world when they're already having financial troubles. So this idea that they can just walk away from the dollar and have no negative consequences is, in my opinion, it's not reality.
What's the impact of the strengthening dollar?
So I think one of the knock-on effects of my thesis of the dollar getting stronger is that it creates chaos in the rest of the world. It creates deflationary events in the rest of the world. It creates economic pressure, downward pressure in the rest of the world. And so as a result, I think that sends capital to the United States for no other reason, just a safe haven bid. But then it creates this vicious loop where it pushes U.S. asset prices higher, it pushes the U.S. dollar higher, which creates even more pressure outside, which leads to even more flows coming. And what that does is it shows you, it increases the demand for U.S. price assets. And you can see this being, and where there's demand, the supply will be added. And so where you've seen this in the corporate bond market in the last 2 months, they've issued $75 to $100 billion in new corporate issuance. And that's demand for dollars. Those are issued in dollars, right? And so there's great demand for dollar-denominated debt. And if the market wasn't there, then they wouldn't be supplying it. So, I think that's further evidence that this is happening. I also have said that there will come a point where overseas investors will not just go to our treasuries or our fixed income, but they will increasingly start to see U.S. equities as a safe haven or a way to seek some alpha. And I've used the example before of, I think a year ago, I talked about if I'm an Italian pension fund manager and I'm looking how to allocate assets and I have a choice between buying an Italian bank or a U.S. bank, I'm buying a U.S. bank. Or, if I'm buying a European credit or a European corporate versus a U.S. corporate, I think they'll increasingly start to allocate to U.S. corporates. And in the last month, we've seen the largest sovereign wealth fund in the world, which is the Central Bank of Norway, has recommended that they decrease their allocation to Europe and move those funds to U.S. and including U.S. equities. So, a lot of this stuff is taking longer than many of us think it will, but you can see it moving in that direction. And I think as we move forward, we're going to see even more of that type of stuff that the Central Bank of Norway is already considering, coming to the U.S. And, I think to a certain extent, this is already happening. It's why our assets or our U.S. Equity markets are near their all-time highs. And here's an interesting thing to do. Take a look at the European equity market. Look at it in euro terms. It doesn't look horrible, but look at it in dollar terms. It looks really bad. Then flip it around and look at the Dow. Look at the Dow in dollar terms, and it looks okay. Not amazing, but looks okay. But look at the Dow in euro terms. It looks really good. It's clearly broken out. So, if you're a euro investor and you're looking to allocate, and you use charts as part of your analysis, and you're looking, do I allocate to the DAX or do I allocate to the Dow? It's a pretty simple answer, in my opinion.
Will gold and dollars rise together or diverge?
Yeah, so back in 2016, I started talking about the dollar getting stronger. And even then I said, at some point we will get into a point where the dollar and gold will rise together. In the last year, we've kind of seen that. A year ago, gold was around 1,200, and now it's around 1,500. Hell of a run. And over that time period, the dollar's gotten a little bit stronger as well. And I think that ultimately, there is nothing more bullish for gold than a strong dollar. Now, if you're a non-dollar based investor, if you're denominated in euros or yen or Australian dollars or pounds or whatever it is, pesos, I think you should have and still can back up the truck on gold. I'm not convinced that we're breaking. Now, we've had a hell of a run in even dollar terms this year, which now you see gold rising in all currencies, and you're seeing the dollar and gold rise together. I'm not yet convinced that it's for real in dollar terms. It might be, and if it is, that's fine. But it won't surprise me if gold pulls back in dollar terms in the short term. But ultimately, what I think will happen is the dollar will get so much stronger that it will literally break the global monetary system. And there's really nothing more bullish than gold than the dismantling of the monetary order and the traditional monetary system. I don't think we're there yet. I think a lot more pain needs to come. But when that happens, I think gold will be one of the biggest beneficiaries of that.
Why are international central banks buying gold?
One of the obvious impacts from the central banks around the world is not just the monetary stimulus that they've provided, but they've been buying a lot of gold over the last several years as well. You see the Central Bank of Russia, the Central Bank of China. A lot of times those are quoted, but even smaller countries around the world have been buying gold. And I think they buy gold for two reasons. One, they want to diversify their reserves. They've already got a lot of dollar reserves. They don't need to have it all in dollars. And I think the other thing is that they know that if they have gold, they to a certain extent have a seat at the table if there's ever a renegotiation of the monetary system. But the other reason that you buy gold, the reason that central banks buy gold is also the same reason that individuals buy gold. You buy gold to use in a crisis. When things really get bad, that's your insurance policy. And countries are not immune to really bad times. If you look around the world over the last 6 or 7 years, gold in non-dollar terms has done pretty well, and it's near its all-time highs in several currencies. Now, it's not quite back to its all-time high in dollars. It's been edging up, but it's still not back to its all-time high in dollars. But if you look in euros, if you look in Australian dollars, if you look in Canadian dollars, if you look in yen, it's done okay. So, gold is doing exactly what it's always supposed to do for the non-dollar investor. Now, the interesting thing that I find with the central banks that are accumulating gold is nobody wants to cash in their insurance policy, but if you get into a disaster, that's what it's for. And over the last 2 or 3 years, you've seen some countries get into dire straits, have some disasters, and they've needed to cash that insurance policy in. You look at Venezuela, they've been selling their gold for dollars to fund their government. In Turkey, they had to sell gold to finance some of their trade and some of their government when the U.S. put sanctions on them. I won't be surprised if that happens. I'm not saying that all the central banks are going to go out and sell their gold, But as countries come under pressure, that will be one of the options that they have. And I think some of them, whether they like it or not, will be forced to use their gold as a means to fund their governments. Now, if we have a monetary disaster in the next 6 weeks or the next 6 days, and there's not that I think there will be a progression before the monetary system resets. But if it just resets right away, then they've got their gold. They don't need to sell it along the way. But if this monetary crisis plays out over a 2 or 3 year period rather than a 2 or 3 week period or a 2 or 3 month period, as the knock-on effects happen, I think some of these central banks will be able to force to sell their gold. And here's something that just happened in, I think it was July, maybe it was August. There had been this central bank sales agreement between the central bank, between all the central banks and the Bureau of International Settlements, which was a negotiated gold sales. You couldn't sell without being part of this coordinated selling program because they didn't want to have uncoordinated gold sales. Well, that's been removed. Now, a lot of people in the gold world have said, this is bullish. They're removing these sales agreements. They're no longer cooperating. Everybody's going in to buy. But this agreement never kept them from buying to begin with. This was a gold sales agreement, and it wasn't a gold buying agreement. Now, why are they all of a sudden removing a sales agreement if it didn't prevent them from buying to begin with? Well, I think they might have to sell some of their gold. So I think they remove it because they know that some of them might have to sell their gold. Now, this is a great advantage for some people. Russia, if they want to buy more gold, well, if Turkey has to sell it, maybe Russia buys it, right? So some of them will see it as opportunity, but some of them are going to have to sell their insurance policy, I believe. And so it'll be interesting to see how this all plays out. Ultimately, this is extremely bullish for gold in the long term. But I think you got to realize that just because it's bullish inevitably, it doesn't mean it's bullish imminently. And I think if we haven't learned that over the last 6 years, we haven't learned anything.
What's your outlook on China?
Yeah, so going back to China, I've been kind of outspoken that China is in more trouble than many people think that they are. I continue to think that's the case. You're seeing it also starting to bubble up in Hong Kong. And what a lot of people don't realize is the troubles in Hong Kong are not unrelated to the troubles in China. And there's a friction there. And I think both the Hong Kong Monetary Authority and the Chinese Central Bank are both under pressure from their dollar funding needs. I think that as the dollar gets stronger, that increasingly plays into the troubles that they're going to have. I mean, at the end of the day, the trilemma that China has, you can't have a independent monetary policy, an open capital account, and a fixed currency. And that's why they have a fixed currency, because they don't have the open capital account. And if they want to internationalize, they're not going to be able to maintain that peg. And I think when that peg goes, I think it goes hard and it goes fast. And I don't see how China gets out of this without their currency depreciating remarkably. Now, whether it's forced upon them or whether they decide to do it on their own, I don't know. But one of the biggest trades we have on right now is we're short the Hong Kong dollar. We think the peg is going to break. And we think when that happens, that's enormously bullish for the dollar. It has a number of knock-on effects around the world. We think that will be incredibly deflationary for others that have dollar funding needs. So one of the other biggest trades we have is long Canadian bankers' acceptance notes. Now, many people have probably never even heard of Canadian bankers' acceptance notes. It's very similar to euro-dollar market. If you bought euro-dollar calls because you thought interest rates were going to go down, so you buy the calls because it's a bet that they're going to cut interest rates. And people like Raul and some other people around the world, John Burbank, have talked about this great euro-dollar trade that they made a great call a year ago. This is the same play, but it's in a smaller market that not many people even know exists. I think there's like 5 people in the world that trade these things. But we put a big trade on last week, and we've been putting it on over the summer. We put more on last week. And we think that the Central Bank of Canada is one of the few central banks in the world that is not easing right now. Their policy rate is 1.75%. If you look around the world, Australia's cut, the ECB's cut, even the Fed has cut, Japan's got easy money, Poland's got easy money, Brazil's got easy money, New Zealand's cut. There's this easing bias around the world that central banks believe that they're going to need to ease monetary policy. The Bank of Canada has so far resisted. And we think the idea that Canada can stand alone against the rest of the world is just wrong. And so we think that they're going to be forced to cut. And if they're forced to cut, these Canadian bankers' acceptance notes will appreciate, and But right now, they're factored in one cut in the next, I think, 18 months in Canada. We think that it's possible that they have to cut dramatically more than that. And so when that happens, this trade on the backs, the Canadian bankers' acceptance notes, like, I don't want it to be dramatic, but just the math of these things, if we get it right, we can make 3 or 4 times our money, and it's possible we make 10 times our money on that trade. Again, that doesn't mean there's not risk involved. Of course, you don't get those types of potential returns without taking risk, but we think it's a risk reward that's worth taking, and we have a high degree of certainty that it'll pay off. And the thing I like about these types of trades is if you're wrong, you don't lose that much. And if I'm wrong and Canada doesn't go into a recession or doesn't have any deflationary pressures and the world economy improves, well, then the other parts of the portfolio do really, really well. But if we're right, and they do, and they have to cut, you make an asymmetric return on this where you can literally make 3, 5, 10 times your money. And the risk reward kind of necessitates you doing this trade. As I said at a conference recently, there's some trades that can be done, but they don't need to be done. But then some trades are so good, they must be done. And I think this is a trade that the trade for the strong dollar, because the trades are so asymmetric, I think they're trades that must be done.
What's your outlook for global growth?
So essentially the way I see is I think the global economy is slowing. I think we're headed towards a global recession. You're starting to see it outside the United States. I think that will continue. I think it will eventually hit the United States, but before it hits the United States, I think the flow of capital from around the world is going to come to the United States. And I think that flow of capital is going to delay our hitting the wall while everybody else does hit the wall. And as that capital comes into the United States, I think that increases demand for dollar-based assets. I think corporates and U.S. government and other dollar-based entities will issue dollar debt, and I think it will be purchased. And I think that will also find its way into the U.S. equity market. I think it's very possible we have a repeat of last year, whereas we had a big sell-off in late 2018. I think it's very possible we have that happen again in Q4 of 2019. I'm glad I was aggressive on equities at the beginning of the year, so I don't have to be as aggressive now. But if we get another sell-off like that in Q4, I think I'll be aggressive buying equities later this year, the same way I was last year, because I don't think we've seen the high in equity markets yet. I think the flow of capital to the United States trumps everything else. Not to, no pun intended. Trump has put policies in place that will increase, I believe, the desire for U.S. assets. And as that happens, I think we will have a blow-off top in the equity market. I think we're going much higher. 30 to 35,000 on the Dow would not shock me at all, and it's potential we go even higher than that. I'm going to say this again. I say it all the time. This is a story that ends very, very badly. I'm not the Pollyanna that's saying everything's fine, buy U.S. assets and put your head under the sand. I just think that this is the inevitable outcome of a global debt supercycle and the end of the monetary system. I think it ends via dollar strength, and I think before it all ends, we get a supernova, upward swing in the dollar-based assets, and then, there's going to be periods of time along this route that are really, really scary. It's not going to be easy. I wish it was, but it's just not going to be. And I kind of liken it to the Super Bowl. And you either want to be in the Super Bowl or you don't. And you either love it or you don't. And I got to say, it's scary, but I love it. I feel, it's like Tom Brady leading his team down the field with 3 minutes left and they're behind by 5. Kicking a field goal ain't going to get it done. You got to get it into the end zone. And, I don't know if I'm going to get it right. It's very possible I don't get it all right. But if I get it a little bit right, I think we're going to do pretty good.